you 100,000 worth of goods, and all you need to pay us back after 30 days with some kind of interest. So 30 days is a maturity date, and 100,000 plus some profit or some interest. So this kind of arrangement is called notes receivable, in which you also may take a pledge security as well. Maybe you send us some documents for your business registration license, as a collateral or something, whatever can be security, you can just deposit over there. So other kinds of receivables: interest receivables and advances to employees. Like if a employee is sick, or his child broke his arm, he needs surgery, he needs money, so you lend him money. You can also be treated as advances to employees. Like if employee wants to buy a car, you lend the money to employee and receive money on monthly basis with small profits, or maybe free of cost with zero profit. Similarly, interest receivable, the arrangements like we talk about, we give loan and we receive some interest. So that is interest receivable, right? So other receivables can be. So the primary receivables are account receivables or trade receivables, right? Because that occurred, that are natural with the business operation. Business operation is to sell goods, buy raw material, sell goods. That's it. Other receivables include other kind of arrangement like lending money to your subsidiary companies, or even though you can also lend money from your subsidiary companies as well. Parent is asking money from subsidiaries, right? Or subsidies asking our money from head office or parent company. Similarly, you can also lend money to employees. So internal control over cash collection on account, like I told you, it can be served as a control account. How? Because you know that cash is involved in account receivable titles, because you lend goods, so you sell goods on credit, and money is yet to be received. So when money is involved, you need extra check on that. We talked about internal control over cash management because it is the most liquid asset and easy to steal. There is a fraud triangle over there. But similarly, here cash is involved, so there is a chance for fraud, right? Mishandling of cash. So how you can do that? You must separate duties, those who are handling cash and those who are recording cash. There must be a separation of duties. Okay? For example, those who are receiving cash, they must be depositing the cash to the bank, but not recording. The recording slip, they transfer it to the accountant office, and then accountant record on cash books. So there is a separate. So if you are not separating the duties, so if accountant is receiving money and also responsible for depositing the money into company's account, then there is a chance of fraud. Maybe he received 4,000 from customer, but instead of writing 4,000, he write it down 400, and rest of the money he take it into his bag because he's accountant. He's recording. Maybe he transferred that into that. Okay, we received the money and client was he's supposed to pay 4,000. Okay, I made a mistake. It was 400. He recorded and he make a reverse entries and everything is okay. So you increase the chances for fraud. So that's why you separate the duties for those who are receiving the cash and those who are recording the cash. It must be separate person. So similarly, you can introduce lockbox system. What is lockbox system? So in which you ask bank to collect on your behalf and notify the accountant. Simple. So instead of having a person who is collecting the account, collecting the checks, you just ask your customers, okay, scan the code, or this is the account title, pay directly through our directly to our account. So they can send the checks to a logbox system of a system into the banks. They can directly deal with the bank, or customer go to the bank and deposit money of whatever he owes you, and the bank will notify you, okay, this customer had paid the money. Only the accountant only needs to record it. That's it, right? So this is called logbox system. So these are just guidelines. Just pause the video and read it by yourself. Nothing rocket science here. Just read it. Okay, let's just talk about this. So how we account for the account receivable? Simple. When sale happen, you make an entry. What is the entry? Account receivable to sales. $1,000. And when customer pay you back, it means you need to decrease account receivable, increase cash to account receivable. This is number first. Number two. This is how you treat account receivable. So that's it. Accounting is done? No. There are other issues that we need to discuss. Number one, when you are allowing credit or allowing a client to pay you back, there comes a risk that you may not get your full money back, right? So it means there are some uncollectible accounts. Even though you are very careful, you are giving credit only those customers who have established a past history with you. But even then, some clients may go bankrupt, may have difficulty, or maybe their business is just bankrupt, close, or they did fraud or something, and they are unable to pay. So, smart managers, what they do, they in advance plan all these kind of stuff before, allowing the company to have credit sales. Why they do that? In order to plan better, right? So when they make uh, cash budgets, because in budgets uh, you make some plannings. Okay, in this month we would be needing this much amount, so that you are according to your plan. So smart managers must follow the plan. So smartness is they also count for, okay, from receivable we may not be receiving 2% or 3% of the amount owed to customers. So they plan accordingly so that their plan may not go wrong, right? So they are according to plan. So that is called smart management, right? So when you evaluate the collectibility of of the customers, you create an allowance, you create a reserve, right? So let's just talk about. So some question may ask why we allow credit. So we do have some benefits of allowing credit. Number one, customers can buy on credits, so sales and profit can increase. So it is, in 21st century, it's almost impossible for any big business not to sell on credit, because company wants to expand locally and internationally. So they do, you know, uh, take that risk to sell on credit. In that case, you expand your sales, you expand your profit, you expand your market share as well, and you remain competitive. So that company who offers credit to its customer, of course, customer will go to him, go to that company. So that company also capturing market share as well. So what is the cost? So what are the flaws or drawbacks of selling on credit? Number one, company cannot get collection from some customers. Some customer may go bankrupt or say or refuse to pay whatsoever. So in that case, it is an expense. You sell the goods, money is not being received, so that is called uncollectible account and that is expense, right? And expense is always bad because it reduces your profitability. What is the formula for profit? Sales minus expenses is equal to your profit. So when expense increase, profit go down, which is bad for the company. And a smart managers or employees or accountant, they must control the expenses because the objective of a company is to make profit, and profit for those who owns the company, for shareholders, so that shareholder wealth can be increased, right? So we have benefits, we have drawbacks as well. So smart, like I told you, smart managers, what they do, they in advance they plan. For example, okay, we plan that our sales is going to be increases to $2 million this year. $2 million, right? And we are a big company, so we let's just suppose that we our all sales are on credit. It means 200,000 we worth of goods we sell to our customers, and customer will pay us this $2 million later. Some will be paying us in 15 days, some will be paying us in 30 days, some will be paying us in 60, 65, or 80 days, whatsoever, 90 days, right? So they plan accordingly. So for example, they said, okay, 2% is not going to be collectible from their past history or whatsoever, or from their competitors. They analyze the reports and they find out that, okay, 2% is normal, that people are having some financial troubles. They refuse to pay us. So 2% of 2 million is how much? It is close to, it is 40,000, right? So rather just waiting and experiencing at the end of the year that 2% is not going to pay us and disturb your planning, your budgets, because everything is based on your cash budget, right? Because you sell the goods, you plan on the basis of cash budget, right? You book your material, raw material, on the basis of cash budgets. And when your sales, your orders based on your booking of the raw materials. If orders increase, then you need to book more, and this whole disturbs all the cash payments. So does the cash budget. So smart managers must be, doing the things according to plan, according to budgets, right? So in order to plan better, they in advance they make allowance, or in some books it is called allowance or reserve for bad debts. Bad debts. In your book, it is called uncollectible, allowance for uncollectible. Allowance for uncollectible. So don't worry about, different kind of name. The logic is the same. Okay? Allowance for uncollectible accounts, or allowance for bad debts, or reserve for uncollectible accounts, or reserve for bad debts. So this is, in some books you find the word you find the words reserve instead of allowance. In some books you find uncollectible as bad debts, DEBT, bad debts, right? Customers are bad, they are not pay us their, so they don't pay their debts, so we call this uncollectible account or bad debts. So we stick to this word here because we following American method here, American book here. So they call uncollectible accounts instead of bad debts. Okay. So records collection losses based on company's collection experience. So you plan in advance, and how you plan on the basis of